Let's bring in Tom Piotrowski now over at CommSec. Tom, good morning to you. So Peter didn't quite steal your thunder this week. He was going there, but then he pulled back again. He didn't want to get you offside. No one wants to do that. So how are our markets looking up today? How do we start the new week?
Well, Pete, I suppose we're anticipating what is a more intuitive start to the session, given what transpired at the end of last week for the US markets. Even seasoned market participants on Thursday, for example, were quite quizzical as to the ability for the US share market to rally to the extent that it did, given those hotter than expected core inflation numbers, which is what the US Fed looks at most closely. So, from its trough to its peak, the S&P 500 over the course of the previous session was up by 5.5%. So there was a brief moment at the beginning of Wall Street session on Friday where the markets were higher. The S&P 500 was up by about 1%. And that was just a free swing at the piñata as far as sellers are concerned. We had the S&P 500 finish around its lows of the session. It was down by 2.4%. The Nasdaq even more acute in its selling, finishing down by around 3%. We saw that continued move higher as far as long-term interest rates are concerned. That translated to more US dollar strength the day before. It seemed to equivocate a little bit and moderated somewhat, but it's strengthened in the last session, which has put downward pressure on commodity prices, Pete. So that'll be something that we'll reckon with in local terms today. But the other important aspect of Friday's session was that it was the beginning of the banks reporting their numbers, and on the whole, they were actually quite good. So that might be the keel that stabilises things ultimately, but it should be a positive as far as the local picture is concerned. Those US bank earnings, they've performed quite well over the course of the last couple of days.